Hey everybody, what's happening? What's happening? Happy Tuesday after a long weekend. We're gonna allow people to sort of join here slowly. We'll give folks maybe like 2 or 3 minutes to join here. Hey everybody, my name is Pat. I'm the CEO of Bitwave. We'll go through intros here in a second, but I'm gonna give everyone like 1 or 2 minutes to join up here. Today we are talking about token genesis events and how you account for it, how you pay taxes for it, and how you protect yourself from a legal perspective. This should be a lot of fun. Jack, Rodrigo, while we're just saying hi while folks are joining, say hi. How you guys doing?
Hey everybody, I'm Rodrigo. I'm a lawyer at Cooley in our Miami office. Glad to be here with you all.
Hey everyone, I'm Jack Karagulleyan. I'm a tax principal in Los Angeles at BDO's office and our co-leader of the digital asset practice nationally. Excited to talk to you guys today about TGEs.
This should be really, really, really fun. I'll start with just a little bit of housekeeping while folks are joining here. So there's two parts about this. One is there are CPE credits available for this. So what will happen over the course of this webinar is that you will be prompted at 3 different times to do polls, and you need to answer that poll. And if you do this, if you answer the poll, you saw one that just popped up right here. If you see a poll, you need to answer it, and then by answering all three, you will be able to get your your one CPE credit of NASBA certified CPEs. That'll go out over the next couple of weeks after the webinar for that site. Second of all, we'd like to give a special thanks to Arbitrum, which is sponsoring this webinar through a grant. Arbitrum obviously is a vested interest. Before the webinar started, we were having a debate about where new tokens are launching and where value is getting captured. That I'm sure will leak into the webinar here. Arbitrum is one of those places where a lot of new tokens are being launched, and so that's obviously a part of why they were being involved with this site. So there should be a lot of fun here. Things that you can hope to learn today would be, thinking about what a TGE or what a token genesis event is, how to think about it from a tax perspective, how to think about it from a legal perspective, how to think about it from an accounting perspective, and then if there's any other implications here around some of the new rev procs that have come out, some of the new rules, anything like that at all. But again, I'll just briefly say thank you very much to the Arbitrum Foundation for the grant to do this webinar. It's a lot of fun. This should be a really, really good time for everybody. All right, I think everyone already sort of introduced themselves. Just quickly, my name is Pat White. I'm the CEO of Bitwave. Bitwave does digital asset back office software, so a full platform for businesses using digital assets. That's everything from accounting to tax to financial operations, and more recently, things like payments, which is going to be a really fun topic this year. Everyone's getting into payments. Jack, really quickly, you want to just talk about what you guys do over at BDO and what
Sure.
people might want to reach out to you about?
Sure, absolutely. So as I mentioned, I'm a tax principal and co-leader of our digital asset practice, and really we help with everything from startups to larger companies looking to do IPO. And in addition to tax, we also help with audit and advisory.
Awesome. Rodrigo, same question to you.
Sure, I am Rodrigo. I'm a special counsel at Cooley's Miami office. My practice focuses with working with crypto founders and investors, from everything from formation, bringing on the team, token generation events, and I promise you, even though the events of this last weekend might make it seem otherwise, you still need to talk to a lawyer when you're launching a token.
Yeah. Oh man, it's fun times. Always fun times in crypto. So here's what we're briefly going to touch on here. So first and foremost, it wouldn't be a webinar like this at the beginning of the year if we weren't talking about trends we're expecting to see in 2025. So that's going to be a fun one here. Obviously, we want to talk about sort of the key tax considerations. Jack, as a tax specialist, will be diving deep into all of the different tax implications that come along with token genesis events. We're going to be talking a lot about kind of the current state of the art practice, which is how you structure organizationally. This could be subsidiaries in different geographies. There's gonna be a lot of discussion about that, honestly, because of the new leadership in the U.S. There might be more opportunities for U.S. based tokens, which we just haven't had. So there'll be a lot of discussion around that going on. We'll be doing a really close look at the TGE event itself. So exactly how the minutia of that happens. Other tax considerations to come into play here, other accounting considerations, and then obviously we'll finish as we get to the end of this hour period here. We will finish with some discussion of the legislation. So A couple of executive orders have already come out. We expect to see a lot of legislation this year. We might see some bills get revived from the dead that had kind of sputtered out. So we'll spend a little bit at the end with talking about some of the new legislation, and then we'll save the last 5 to 10 minutes for Q&A. But you know what? If you have a question, please just raise your hand. There's a Q&A part of the webinar here, so you can just ask a question of the panelists. We will jump in. We will answer it. We will happily pause our ramblings and meanderings to answer any questions. So please just reach out. Chat's open. You're allowed to chat with each other. Please be respectful and have fun. So with that, I'm gonna kick it over to Jack here. Jack,
Thanks, Matt.
what are we thinking about for 2025 here?
I think it's going to be a fun year. And I think the first bullet is probably the most critical one and sets up the other ones, right? And obviously, for the first time ever, we have a pro-cryptocurrency administration. And really, companies are looking for clarity here, right? There's a lot of traditional companies also, and in addition to crypto natives, right, that just need clarity to get into the space. And I think, the hope is that we get it sometime later this year, right? We're still not sure whether it be Q1, Q2, but there's already some draft legislation, which we'll talk about later on in the presentation. And obviously that will set the pace for companies to adopt digital asset use cases in their business, right? This could include digital ID, it could be a marketing program, some sort of loyalty points on the blockchain, could be credit cards, or it could be DeFi, right? And businesses already are accepting digital assets as payments, but I think we're also going to see a lot more of that when you look at some of the largest fintech players, right? From Square to now Stripes that acquired a company in the space, right? Some of them are launching their own stable coins. So I think the payment aspect is also very real. Actually, just this morning, the CEO of Bank of America said that this is something that they're hoping to get regulatory clarity on this year to start being involved in the payment space, right? So we're seeing it firsthand on a daily basis. Tokenization of real world assets. I think this has been talked about a lot over the last year or two, but we're starting to see a lot of those use cases, right? From BlackRock and other large private equity funds tokenizing some of their funds. On the real estate side, we're starting to see houses be put on the blockchain from a title perspective. There's some exciting stuff there. And even like I'm in California, right? Our driver's licenses are officially on the blockchain, right? So a lot of this is happening and most people don't even know about it, right? So whether we know it or not, I think we're going to continue to see this trend in 25. More businesses are going to consider whether they should be mining and staking, right? There's this whole aspect of stranded energy now. There's companies who have this energy that's not really doing anything, not profiting for them. And given just the structure of some of these protocols, right, they could potentially revisit putting that energy in a more profitable way.
Energy is going to be a big topic this year. Between AI and blockchain, energy is sort of one of the new, I don't know if battlegrounds is the right way to put it, but it's this new innovation frontier where suddenly you have so much money flowing into energy that had not been. It had not been a particularly sexy industry. There's so much money flowing in. Every AI company is buying their own power plants. You now have a lot of the traditional blockchain companies buying their own power plants and power production facilities. This will be a super interesting year for any sort of energy companies, any sort of power generation. And then also just like, yeah, how that overlays with blockchain and how folks put their tokens to work in some ways.
Absolutely. Stable coins and payment adoption, I think what we're starting to see is given the volatile fiat currencies around the world, a lot of non-US folks who don't have access to US bank accounts are now requesting, if not demanding, to be paid in stable coins, right? So we're even getting traditional companies asking about this. We'll continue to see more of that. I think stablecoins just eclipsed 200 billion in market cap. It's already been growing, but there's also stablecoin legislation that's out there that once it passes is just going to encourage companies to continue to look at stablecoins as well. The next one's my favorite bullet, right? Increased convergence between AI and crypto projects. So for those of you who haven't heard, 2025 is also set to be the year in which AI agents really hit the map. And AI agents are just software programs that perform tasks, right? So it's the next iteration of ChatGPT, but now they do stuff for us. They don't just answer our questions, right? But the thing with AI agents is they're very good at one or two things right now, right? But they may need other AI agents to help perform the task. So in many cases, we're already starting to see one AI agent transact with another. And last I checked, they cannot have US bank accounts, right? So naturally, digital assets is what they're going to likely be using, right? So interesting to see how this plays out. And in some cases, we're even seeing AI agents release their tokens, right? When the token has some sort of utility. So if you want that agent to perform a task for you, right? You have to use their token, right? So this is going to be, I think, a really interesting use case, because if we're anticipating millions of new AI agents, those are millions of new potential participants on the blockchain networks as well.
It's not just about the bank accounts. I mean, the biggest piece here for me really comes down to programmability. Like, you just can't, it is really hard to program agents to work with bank accounts. It's really hard to program against bank accounts in general. Like, that's why Stripe is an entire company, because it's hard to program against bank accounts and credit cards, and all they do is sort of moderate that. And so, like, if you are looking to actually enable or light up some sort of use case, you just can't really do it with bank accounts, and you certainly can't do it at speed, not the speed that agents are actually operating at. So the first place, I mean, I've been saying this for a couple of years now, the first place AI will be interacting with money of any form will be on the blockchain. Like, you're not going to hook up. There is no world where you're going to give an AI free reign to your bank account. You're going to set up a smart contract that has limits and controls and, like, potentially double signatures and things like that. And that'll be how agents actually operate these things. So it's gonna be an exciting year. I mean, there's a lot of good synergy between AI and crypto. I think there's a lot of hype that you should be careful of here, like AI on the blockchain and stuff like that. Like, that's not really a thing, but agents starting to actually use the blockchain through digital assets, phenomenal. Like, that's really cool stuff.
Absolutely. And finally, all the bullets prior to this will help to encourage increased token genesis activity, right? We're going to see companies start to revisit this, especially with the regulatory clarity that we're expecting to get. So some exciting times ahead.
Yeah, maybe I'll jump in there quickly just on the last point. I think from a regulatory perspective, like, we're seeing a real kind of paradigm shift between the prior administration, which took a pretty kind of hostile approach to crypto, and basically try to deal with it through enforcement only. And we're now seeing kind of like the new SEC being set up, which is much more willing to try to set out some rules of the road and expect it to be much more crypto favorable. So I think from the legal and regulatory perspective, it's a very exciting time for crypto, because we'll finally be able to have a government that's, like, interested in incentivizing this technology to develop in the US.
Yeah. So that's what to look forward to this year. So Jack, tell us what we got to start thinking about from the tax side this year.
Yeah, absolutely.
And in particular around the token genesis events.
Yeah, so I think this slide is a good refresher for those of you who don't know, and for those of you who haven't seen it before, will help to create the foundation of the tax rules that we'll be dealing with during our presentation, right? And as we talked about, we don't have a lot of regulations around taxation for crypto, but we do have bits and pieces that we've gotten over the years. The first one being IRS Notice 2014-21. What that did for us is it clarified that digital assets are to be treated as property and not currency for tax purposes. Now, that's important because there's certain safe harbors and permissions that currencies allow that property does not get, right? And we'll talk about that a little bit later on. Sales and exchanges, right? So use of digital assets in sales is taxable. I think most people know that when you sell for cash, you pay tax on the gain. One thing to call out here is some people still ask me, when we're just swapping one coin to another, it's a similar coin, like, is that taxable? Answer is yes. So if you're swapping on a DEX every single time, even if you do 100 swaps, 1,000 swaps, every single one is taxable. That's why you use a company like Bitwave to help you out. Earning any sort of service that you provide and you get crypto, right? Naturally, the fair market value gets picked up in income. Airdrops. So airdrops, whether it's NFTs or tokens, right? It's been happening for years, but I think what we've started to see in the last couple of years is more of an infrastructure built around it, where you have to go and claim the token, sometimes press a button. I think that's important because the IRS guidance that came out said that airdrops and any sort of hard forks are taxable once you have dominion and control, right? So once you're able to access it and sell it, that's when it's taxable. So when you're dealing with airdrops, right, as some of you know, like, the price can come out really high or really low, and there's a lot of drastic movement the first few days. So when you click that button, that's when you would have the taxable event. Staking, we had a rev rule come out 23-14 that stated that staking rewards are to be picked up in income, again, when taxpayer gains dominion and control. And this is the position we usually see. It's the conservative one. There is another position that some companies take if they have the right fact pattern, where they argue it's self-created property and it shouldn't be taxable until disposed, right? So consult with your tax advisor or us on that if you have any questions. But it's something that is out there that people should know. And finally, cost basis method. And really what this talks about is around how you go about choosing the cost basis of the digital assets that you're selling, right? And it outlines some methods that are available for taxpayers. I think the optimal one that people strive for is called the specific identification method, known as spec ID. And in short, what that says is if you choose the lot that you're selling ahead of time, right, and you meet the record keeping requirements and the rules, then you get to choose the basis that you want to use, right? And depending on the tax period, the year, and the attributes, you may want to use a lower basis or a higher basis, right? Depending on what the big picture looks like. But companies should be aware of this. And again, later on when we talk about wallets, we'll dive into some more deeper rules around this. And if you don't qualify for this, you would default into what's called FIFO, first in, first out basis.
And this is one we'll be talking about, a new rev product that came out 2024-28 that did go into more detail about how to actually do spec ID, and that changed some of the guidance around how to actually select like when you have to select the ID, the asset. What I like to like the takeaway from this slide that I always talk about is like we love to say in crypto circles, people love to say there's no guidance. There's, oh, like I don't know how to like do treatments here. There's no guidance on this stuff. That's generally not true. Like most of the rules that are out there can be applied to crypto. When I hear someone in the crypto world say there's no guidance, what I generally hear is like they don't like the guidance. So that goes for things like airdrops. They don't like that you have to recognize it as income. They don't like that staking can't be treated as a self-generated asset. It's one of those things, like most of the stuff is actually relatively well defined at this point from both an accounting and tax perspective. There's still a lot of regulatory issues out there in terms of like, does the CFTC or the SEC control it? What constitutes a commodity or versus a utility token versus a governance token, all that kind of stuff. There's a lot of regulatory guidance there. But in terms of like the treatment and what the IRS expects you to do, a lot of that is pretty well defined at this point. There's some places you can wiggle around if you have particular fact patterns, but you should kind of assume that most that's been figured out, and your professionals that you work with, the BDOs, the Bitwaves, the Rodrigos of the world, Cooleys of the world, will be able to kind of help you out on that side of it. So you might hear a lot of pundits say that there's a lot of ambiguity. There actually, for a lot of this stuff, it's actually pretty clear cut if you want to take a conservative approach. Oopsies. All right. Let's get deep into the TGEs now. All right. So who was Jack, were you going to take this slide, buddy?
I think Rodrigo's going to start us off on this.
All right, Rodrigo, take us away, my man.
Sure. Thank you for this. All right. So talking generally about the couple of legal considerations that should be front of mind when you're launching a token. I think most projects are going to be focused on securities laws, which to date have been the main focus of enforcement, right? The general approach that we like to take here is to try to do what we call the belts and suspenders approach, right? So initially, you want to have your arguments for why the token that you're issuing is not itself a security. And there's a couple of different flavors of this argument, right? You can have an argument that says that the network is basically sufficiently decentralized. Therefore, the purchasers of the token are not relying on the efforts of any individual contributor, so the whole arrangement should not be a security. A different type of argument that you can make here is that the token provides some sort of utility or consumptive use, right? This was basically like the utility token argument in the first wave of the ICOs. You can also maybe fit meme coins here as one of the consumptive use cases, right? Which are saying that basically like this is not an investment. This is just something that I'm purchasing as a product. And then I think it's helpful to have basically a backup to that argument that says even if the issuance of the tokens is deemed a security, you're fitting the security into an exemption such that you're not required to register it and then therefore not liable for like an unregistered offering of securities. There's a couple of different types of exemptions that are typically available, and they will usually require the issuer to either limit the purchasers that can participate, and also to require the purchasers to hold on to the tokens for a while to have some sort of lockup, right? So I won't bore you with all the details of the different exemptions, but just at a high level, The ones that are available are Reg D, which requires you to limit it to accredited investors. These are people that, you know, have a bunch of money and can prove their sophistication so that they're not required to be protected, quote unquote, by the securities laws. Then there's the exemption for offshore sales. And then there's the ones that you can use for distributions to the team. A different type of legal risk that I think has reared its head in the last couple of months and years is a series of lawsuits against token issuers and investors and other token holders that alleges that the whole group of token holders is a general partnership. We've seen, for example, one law firm file a series of lawsuits against DeFi projects premised on this argument, right? The real risk of this is that if the group of token holders is considered a general partnership, then each of the general partners could potentially be jointly and severally liable for the liabilities of the whole group, which, as you might imagine, it could be a really bad result. So this is part of what's really been pushing some of the players in the space to think of new legal wrappers and new distribution mechanics to try to get away from this general partnership, the risk. There are a couple of other kind of big areas of liability that you should be aware of, things like, you know, sanctions, money transmission, which are not covered here, but also, I think, relevant if you're talking with your advisors. Next slide, please.
Well, so I'll mention something here really quickly. This is a great example. Point number one here on the general partnership risk is a great example where just because a pundit says it don't make it true. Like I actually remember really clearly. I was at an event with Eric Voorhees the week that they were doing the dissolution of Shapeshift into a DAO, and you know, since we do this stuff with the accounting side, like it was, I know this stuff pretty well. I've started a few different companies, so I know the reason that we have corporate structures and stuff. Like at the end of the day, like people think of this idea that you have to form an LLP or corporate structure. I guess some folks or some pundits think of it as a bad thing, but at the end of the day, the reason you do it is to protect yourself. Like LLPs are not bad. Like they protect you as an investor, as an operator of a company. C Corp's the same thing. And we got in this like heated discussion about he basically was like, look, I'm going to dissolve this and it just won't be an issue. Like it just doesn't, like there is no company. The world, the universe owns this idea, this content, all of that kind of stuff. And that's great to think about. Like there's this like, you know, wish it and make it so sort of part of entrepreneurship that maybe he was subscribing to. But at the end of the day, that's not necessarily how corporate structure in America works. It's not how liability law in either America or the rest of the world works. And it certainly is one of those things that like, just because it sounds good to have these things be totally decentralized, that actually is not always the best case. Like you want protections. Like protections are good. It's good to shelter money in. Like if you think about how Hollywood takes the exact opposite form of the way that we do this. Like Hollywood and real estate, they take all of their liabilities, they stuff them into these corporations, and if anything goes wrong, they just nuke it. And it's this like beautiful format that they built to enable like better innovation on their own part. And you could say, you know, there's some bad part of that also, but it's an innovative model. Then in the crypto world, we like totally ignored because like decentralization, like, you know, the original ethos, a very anti-government ethos that came from Bitcoin when it was first started, has kind of grown into that. But don't be afraid. Like what I would say, like, don't be afraid of corporate structures. Like it's not a bad thing. Like for some reason, it's a four-letter word in crypto, but it actually is not necessarily a bad thing to protect yourself.
Yeah, I mean, I think just the last thing I'll say on that point, I think one way to frame it is if you don't form a corporate entity yourself, you run the risk of a court defining what type of corporate entity you are. And that is most likely going to be a general partnership, which is a very unfavorable type of legal entity to be.
We're basically everyone, I'll just like where basically everyone has equal liability, right? That's correct?
Would be joint and several liabilities, the term, like after you exhaust the assets of the entity itself, which basically means like you can be left holding the bag for everybody.
Yeah.
I mean, I'm also cognizant that there's no perfect legal structure for most like crypto native organizations, right? So all of these involve some sort of trade-off, either in how easy it is to come in and out of the organization, the tax situation. So there's no perfect solution. There's trade-offs, but it's an issue that is, I think, going to become more and more salient and important for projects to think through.
Yes.
So this next slide basically lays out the general structure for a token distribution that presumes a kind of like offshore foundation. And I think one way to kind of talk through this is to just sequentially go through the steps that would take place for the token to be distributed, right? So you'll start with your US Labs Co, which is the entity on the left. That's where you raise venture financing, like I mentioned earlier. And then once you're getting closer to the token generation event, you would set up the offshore structure. You would transfer certain IP from the Labs Co to that foundation. And then the foundation would use that IP, which potentially includes kind of like the mint contract, right? To create the token. And then that token gets distributed back to the development company, which itself distributes that to the team and the investors, and then retains some sort of treasury to make grants going forward from that entity, right? And then when we talk about a DAO, right, that's basically in many ways a organization that's made up of token holders that expresses some sort of opinion about different ways that the foundation or the protocol can operate, right? As part of the decentralization strategy of a lot of projects, you will transfer a lot of the control of the protocol and potentially the treasury to this group of token holders. There was a question in the chat that I saw pop up that is kind of like consider the trade-offs between the DUNA and the offshore, like the Cayman structure. So maybe just to address that quickly. I think there are several kind of key trade-offs. One of the ones that has been most salient recently in lieu of these lawsuits that we've been talking about is the different relationship that the token holders have to each entity. The Cayman foundations are basically trusts. They are a organization that is directed by like a manager or a director, and they have a pile of money that they can make grants from. But the token holders have no formal relationship to that entity, and as such, don't benefit from limited liability, right? So you run the risk that if you have a foundation, you could still, if you have only a foundation, you can still have this claims that the token holders are general partners. Animated mostly by this fear, a bunch of actors in the space have been pushing for new types of legal entities, including the Wyoming DUNA, which is a kind of iteration on a unincorporated nonprofit association. And importantly, there, the token holders, just by virtue of owning a token, become members of the entity and therefore have limited liability. The kind of downsides of the DUNA are, you are a U.S. entity, so you're subject to U.S. tax, although some of the proponents of the DUNA would say that the Cayman foundations are just, running a bunch of tax risk, which Jack can talk a little bit more about later. And you have a little bit more nexus to the US, right?
Yep. Really quickly, Rodrigo, I just want to talk about the timing component of this slide, because there is a really interesting timing component here that I just want to mention. I actually want to ask you some questions on. So oftentimes the US Labs entity will be the first to start. So that'll get funded by VC money. You'll start with a couple $1 million. You'll start the Labs entity. When you're getting closer to launch, you'll spin up the foundation. Now, do you need to spin up the foundation and transfer the IP before launch, or can you do that after launch?
I think you do it before launch, right? Yeah.
So then the foundation will ultimately be where any sort of Genesis event tokens are going to land in the foundation. They're going to skip the labs entity. They'll land in the foundation, basically, right?
Yeah, typically, and going one level deeper, the most common structure would use a Cayman foundation company and then a BVI subsidiary and the BVI subsidiary is basically like a single-use entity that is intended to just mint the token and then doesn't do much more than that. The reason for that extra wrinkle is there's a difference in the VASP regime that has been adopted in BVI versus Cayman. And there's more of a risk that if you do the mint from the Cayman Foundation itself directly, you'll have registration requirements under SEMA. So people will do this like two-layer structure. And then in terms of a timing consideration, one of the most important, like inflexible pieces of this chronology is the separation you need between the time the token is minted by the Foundation BVI sub and distributed to the Labsco, and the time there's a public token distribution, which means, a token trading on Uniswap or like on some centralized exchange. And most people will tell you you need about, like 60 days between those two events so that you can take advantage of a low fair market value for the initial part of that distribution, to avoid kind of like tax issues that your employees that are subject to vesting could otherwise face.
Yeah, so that's a tax consideration versus a regulatory consideration.
Yeah.
And then the DAO at any point, basically at any point after this, the DAO can then be created and moved and assets moved over to, right?
Yeah, I mean, well, it depends what you mean by the DAO, right? Like, I think the DAO is generally kind of just like a group of token holders that has some sort of governance control. In terms of like a legal wrapper for the DAO, the earlier you form that, the better, because then you're potentially cabining liabilities from that point forward. Yeah, I think you can.
In a perfect world, I mean, I know everything here says like depends on, but in a perfect world, would you actually do form the DAO around the whatever structure you're using for the DAO? Would you form that around the same time as the Genesis event?
Yeah, I think that would be ideal, right? Because that way you can cabin liability going back to the Genesis.
Perfect. Makes total sense. Jack, anything you want to add on the tax side of this? I know we threw a lot of we mentioned your name a lot, or Rodrigo mentioned your name a lot through all this.
No, absolutely. So I think actually the next slide covers some of those points.
Well, let's do our CPE question quickly, and then we'll jump into the tax side of it.
Sure.
Okay. All right.
So
Jack, do it.
Yeah. So I think Rodrigo covered the typical process on the earlier slide. So looking at the tax considerations piece of this, in general, right, a lot of times there's either vendors or developers working with the US labs. They request to be paid in that token, right? At some point in time, when they do use the token, right, to pay those vendors, it is a taxable event. So the difference between the basis and the value at that time does matter, right? And going back to the timing question you had, Pat, the value really matters, right? So the whole emphasis is the earlier you put time in figuring out the tokenomics and the token distribution and getting that out, right? In the event, it is a taxable event, right? We're dealing with potentially minimal value. I think a lot of times taxpayers assume that until it is traded on a DEX or a centralized exchange, it doesn't have value. That's not always the case, right? So we do recommend that companies understand you could be working on this thing for 2 years. You could have spent 10 million of R&D costs. If the IRS comes in, they're not going to say it's worth nothing, right? So the value does matter. So whether it's the initial token distribution or whether it's the services contract that usually takes place between the foundation and US labs, right? That could sometimes be there, right? The timing and the value really does matter. So it's always a question you got to ask yourself. That's a key component.
And for what, Jack, something that I always say here is like, this is another one of those like maybe quasi misperceptions and misconceptions in the industry is like, there's actually, for you as the company, there are real benefits to being able to not having a zero cost basis token. I think everyone really wants a zero cost basis token just as your sort of knee jerk reaction because you don't pay any taxes on it. But that totally discounts things like the R&D that goes into it and the fact that you actually can there's certain benefits you can get from both the tax and accounting side if you don't do a zero cost basis token. You actually can stuff like R&D costs into the token costs and then write that off. And I mean like very, very, very general about it at a very high level. But like it's one of those things like don't necessarily think that like the perfect outcome of everything is a zero cost basis token. In fact, you as a company, like looking at the company perspective, you actually can have some good benefits from putting some of your costs back into the token. I don't think I know for a fact, like not a lot of companies do this. Like not a lot of companies that have done tokens have actually correctly capitalized the token from day one that could have saved them on taxes or corporate taxes or been carried
Right.
forwards they could have taken. Pick it up.
Right, absolutely. I think you always got to have a big picture look, right, and not look at any one issue in a vacuum, right? So I completely agree. Transfer pricing, for those of you who don't know, essentially when you have related parties, right? In some cases, it's possible labs could be considered related to foundation. We'll talk about the control piece soon. When that happens, any sort of service contract needs to be at arm's length, meaning you would pay what a third party would pay. We're going to talk about the control element shortly, but it's even if you're talking about the foundation being ownerless and not controlled by the U.S. labs, it may still be a good idea to keep any sort of services contracts at arm's length, right? Because the whole analysis of determining who controls the foundation is not a bright line test. It's a gray area. They look at several factors, so something to think about there. Rodrigo mentioned that sometimes the companies take these tokens and give it to their team members, right? You should consider 83B elections. Again, whether you do it or not depends on the value and the timing of it, right? You don't want to inadvertently trigger a large taxable event for your employees, but that really matters, especially when you think about lockups. Lockups do not defer your taxation event. So a lot of times 83Bs make a lot of sense, but that's why considering founders around with employees, again, all about planning upfront, right, to avoid these issues later. R&D tax credit, a lot of times I've seen companies forego this because they're saying we're not generating taxable income. But if you're a startup in your first 5 years, you could use payroll tax as an offset up to $500,000 a year. So something to think about if you qualify. And then lastly, I won't go into this foreign derived intangible income. We call it FDII. If you qualify for FDII, your tax rate as a corporate entity becomes closer to 14% rather than 21. So it's worth consulting with your tax advisor given, and the reason why we bring this up for crypto is because a lot of the users are non-US, right? So it's foreign derived and a lot of the income is intangible based. So something to consult with your tax advisors if you haven't already.
No, I didn't know. I didn't know much about that. That's super interesting.
So moving on. So let's talk briefly about what a CFC is and why it matters. So a CFC is a controlled foreign corporation, right? That essentially it's a foreign entity that's 50% or more of US shareholders, right? And when you're factoring in the US ownership, it's important to understand that it's not just voting power, it's vote or value, meaning they also look at control, whichever yields the higher result, right? So usually when calculating that 50%, you factor in only 10% shareholders, right? And the reason why that matters, let's go on to the next slide, is around the foundation piece, right? So who controls the foundation? A lot of times, as Rodrigo mentioned, these are ownerless entities, right? I think he talked through all the stuff in the typical process already on the left side. But that control piece is key because if it's deemed to be the US controlling the foundation, then the foundation is a CFC and they have a US filing requirement and they will be subject to US tax, right? So a lot of times people just rely on the ownerless aspect, but if this was under audit, an agent can ask for the minutes, look at the board meeting, right? Understand who are the board members, right? And every company has a different set of fact patterns. Some folks may have non-US employees, so they're a little bit better fit, right? Some folks choose to relinquish their control over time, right? We call it like progressive decentralization, right? Because a lot of times founders don't just want to let go of control to, board members in other countries, right? So this is probably a really critical analysis, Rodrigo. I don't know if you have anything to add to that. You're on mute, Rodrigo.
Thank you. This is one of the core kind of like tensions in this structure, right? Because I think a lot of projects want to set up offshore foundations so that they can benefit from the perceived regulatory advantages and the tax advantages. But they also have a very understandable reaction that they want to control what's going on in the offshore foundation, right? So you end up in the worst case scenario with kind of like a bloated structure that doesn't really provide you like the regulatory shield that you want and can potentially end up with like bad tax outcomes, right? So one kind of just easy way to think about it is if you're at the DevCo, you should not know what the foundation's going to do, right? If you know exactly what they're going to do and have a way to direct them, then I think you need to think hard about whether that's worth it, right? And there are a couple of also a couple of different variations of like how much meat basically you can put in the foundation, right? The like minimum viable product here is like I said earlier, is just basically like a trust with a bunch of money, and they make grants going forward, right? Some projects try to leverage the foundation to do a lot more of the BD work and marketing work, and potentially some more of the development work, right? So you have to figure out kind of what makes most sense for your project, and how much activity you want to push to the foundation, and then think about kind of staffing and how you're going to deal with all that.
Yeah.
Absolutely. And I think we talked about some of the other bullets. I'll just mention, do the activities of the foundation generate income that's effectively connected income? So what that means is, even if you get through this control test and you're truly not controlled by the US, does the foundation then hire anyone independently where they have activity in the US? They're signing contracts, they're actively promoting, residing in the US. If that's the case, while you're not a CFC, you have a different type of filing requirement as a foreign foundation who has ECI in the US, right? So something to be aware of. Your activities do matter. Go ahead, Pat.
Well, I just say yes. Takeaway on this is that it might seem simple, but it really is not simple. A lot of it just comes down to where you live, whether you're signing contracts for the organization, how you're structured, that entire structure. I mean, like this might be a simplified way to say it, but like there's a reason that like SBF moved to the Bahamas. Like there are benefits to being totally extra, outside the US for a lot of these kinds of operations for it. Jack, we got a good question on 83Bs. And I think 83Bs are super interesting because you taught me something yesterday about 83Bs, which is that companies themselves can do 83B elections, which I did not realize. But we got a good question that I thought we might be worth answering here. How to handle 83B elections for foreign EEs? How would the company handle the tax liability ER tax for that token compensation? Might be one you want to take offline, but any thoughts at a high level?
Yeah, sorry, I want to read the question. Did I miss it? It's just on there.
Oh yeah, you gotta click the more button and then go to Q&A.
Okay, got it. Yeah, I'm seeing the questions coming, but I don't see that question for some reason. Look, my high level thought is, it's important on the 83B side, right? There's a tax side of it. There's also the legal construct. There's 409A rules. So I think it's really important just in general, right? That, again, we don't look at it in a vacuum. So the facts do matter, but there's always planning ahead that you can do, right? Just to optimize it, make sure you understand the tax impact. So happy to help offline as well.
Yeah. And yeah, Jack told me yesterday that the companies can do 83Bs, and that could be relevant in this situation. Like if you as the labs company have vesting tokens, there might be good reasons to do an 83B on that, not just for engineers and employees and things like that.
Yeah, exactly. From a cash tax perspective, you may be locked up, right? So it may make sense to do that.
Yeah. All right, now, so I think we got the question earlier about this, and now we get to jump back to it. It's talking about the DUNA and the different type of DAO structures.
Yeah, so I mean, maybe at a high level, there's different philosophical approaches here. I think you can make the argument that DAOs are not legal entities. They're like thin coordinating mechanisms, right? So we shouldn't necessarily form any wrapper for this, right? Like we said earlier, like that comes with a big risk, which is the court will decide that you are some sort of legal entity. And then looking at
and we've seen that, and for what's worth, like we've seen that happen, right? Rodrigo, like we talked about, I guess we're talking about the BZX case. There was one of the first DAOs that got sued, that got past the initial motion to dismiss, which was deciding whether or not, which was sort of a judge making a first gut call on whether or not this was a severable partnership or not.
Yeah, so this is like Pat said, this was a theoretical argument for a long time. If you go back to like the very beginning of crypto regulation, when the SEC issued the DAO report about like the DAO that was like a venture fund.
Yeah, this is like a historical time travel we're doing right now. I forgot FWB, the DAO, all that fun stuff, man.
I gotta try to flex my cred. There's a footnote there that says basically like these things can be general partnerships, right? And for a long time, lawyers and Telegram chats that I spend too much time with would argue this. And then we saw the first couple cases being filed. There was the BZX DAO and the companion case from the CFTC, which was called Uki DAO, which the BZX one was settled. The Uki DAO, which was the claim that the CFTC filed, ended up in default because nobody stood up to defend the DAO. But they both basically found that it was plausible that a DAO could be a general partnership. A lot of what was honestly driving these two cases was a highly unfortunate statement by the founder of this project, which got quoted, who quoted as saying, everybody's getting sued, but we have this great strategy. We're going to decentralize so that when they come and like the regulators come, they're not going to be able to like find anybody, basically, right? And that was plastered like all over the complaint that the CFTC filed. It was plastered over the opinion that the judge handed down. And basically what was animating this was like, if we think there's some wrongdoing here, we're going to want to find some throat to choke, right? We're not going to just let liability dissipate. So in a way, by decentralizing or like trying to decentralize liability away, they ended up opening themselves up to more liability. And then fast forward that, there's been a series of cases filed by the same plaintiff's law firm called Gernstein Harrow, which is clearly trying to iterate on this type of claim as like their new business model. And they've sued recently Compound and Lido and a bunch of their big investors. And both of those cases got past the motion to dismiss, which means that they're in discovery and they have a large settlement value, right? So this problem is real and becoming more serious. So I think the approaches you can take are, okay, like let's try to form some entity that wraps the DAO. And I think the best example that we have of that is the Wyoming Duna. There have been earlier DAOs that have tried to form kind of like LLCs as the legal wrapper. And that works, but it's pretty constricting in terms of like members being able to enter and exit, right? Like you can't just become a member of an LLC by buying a token on Uniswap. You would have to like go sign a like LLC agreement, right? And nobody really wants to do that. But just philosophically, I think the other approach that people have tried to take here is to say, no, like the DAO is still not an entity, and this is just like a coordinating mechanism. And what we're gonna do is we're gonna try to cabin the most risky activities in entities themselves, right? So what does this look like? It looks like, the sub DAOs that some people might be familiar with that like Maker try to do. For example, when we did, I helped on the investment for FWB that Andreessen invested originally. And there, the approach we took was FWB, the token holders are not an entity, but we're going to form a kind of like entity that they control that is gonna be the one that like hosts the party in New York, so that if somebody slips and falls, the liability is cabined there.
Great. Yeah, I'll just mention briefly, I know we're running a little late on the DAO side. You look at the tokens, make sure if you're assuming that the token holders have control, do they really have equity, right? They don't always have the ability to make voting rights. Is it considered equity from a tax perspective? I think everything else we kind of touched upon previously for the foundation would also apply to DAO as well from a control side. And we can move on to the next slide, Pat.
All right.
And Rodrigo, I want to say we covered the groundwork in previous slides. So I'll just mention briefly again on the tax side, we talked about some of this, right? It's important to set up the framework so that IRS doesn't determine it for you. The payments that DAOs make, right? Most of them may qualify for deductions, something to think about. Make sure you kind of treat it similar to how you would with other businesses. The fee switch, we've seen some talk around that, right? I think it's important to assess. Sometimes the DAOs are set up in a way where it's a nonprofit, but they're, prohibited from distributing, right? So it's still a relatively new area, but something to be aware of if this comes up. How does it impact the tax status of the DAO?
Yeah. That's the Wyoming Duna it is a nonprofit status. That's something to sort of keep in mind that really limits what you can do with it, what you can pay out of it, all that sort of stuff.
Exactly.
Now, that might not be an issue, but it's something to keep in mind that that's a very different corporate structure than we are used to, founders and things like that.
Go ahead.
Oh, I was just saying so I think we're gonna try to speed through a couple of these slides here really quickly, but it's good stuff for you to know. This is kind of the more nuts and bolts of like if you as an organization are going to do a TGE, you got it. There's some stuff that you got to start to do correctly here. So I'll let Jack sort of talk briefly about this.
Yeah, I'll touch on it briefly, given we're late on time. Essentially, it's important for companies to start taking inventory of their wallets, right? So if they have certain digital assets that they use to keep the lights on, pay the bills regularly, then that should be in one wallet for ordinary business use. If there's another wallet where you want to keep it in there from a treasury strategy, you know, you're hoping price goes up, keep it in a separate one, right? It's good to have good wallet inventory because it develops different character in terms of the gain, whether it's a capital gain or ordinary rates. Sometimes you could have different rates apply. And B, it's required. That's how you're supposed to do it, right? And we talked about the spec ID earlier, right? The Ref Proc 2428. Essentially, companies were doing it wrong for the most part because they were using a universal approach where they used basis from all the wallets. So they sold from wallet A, but took basis from wallet C. The IRS came and said, you're not supposed to do it that way. They gave us a one-time safe harbor. We're probably not going to get another one. So it's important that companies spend proper time addressing this. And again, happy to take additional questions offline.
Yeah, this is a good one to go to offline, and the stuff that what Jack just mentioned, that is just it's so incredibly important. It's actually the ordinary versus capital income is a really interesting one that no one thinks about. Like I would say that the vast majority of our customers do not think about that, and it makes a difference because you can segregate your tax liabilities. I mentioned only because if you saw the new 1099 DA, it's finally very, very clear. Like we always knew it was there, but the new 1099 DA has a spot there for long-term, short-term, and then ordinary assets. So,
Yep.
we'll skip this guy because we're out of time on it. But tax, the thing I'll mention here is that like if you are doing a wrapping, if you're using wrap tokens, tax and accounting laws have actually diverged on this. Tax and accounting guidance have diverged. So with the new FASB accounting guidance, you are not allowed to use wrapping tokens. With the new tax guidance, you still are if you do sort of a substantive test. This is, I'll make the pitch for Bitwave here. We have a mechanism to kind of deal with this, to be able to do split books where you have wrap tokens being applied for wrapping, treated as the same token for tax purposes, but not for accounting purposes. If you need that kind of thing, that's the sort of stuff that Bitwave specializes in, is real tricky problems like that.
Yeah. I'll do 15 seconds on this, Pat. Essentially, we're starting to see more loans with digital assets. Because it's property, not currency, sometimes these loans inadvertently trigger taxable events. So there's a whole analysis and there's some bullets here that you guys can revisit in terms of what we look at to analyze. But as you're signing these agreements, terms and conditions matter. Definitely consult your tax advisor. We're always happy to help.
Yeah, and this obviously the reason we mentioned this as part of a TGE conversation is like you're something going to be seeing on all these tokens. You might want to put them to work. You might want to borrow against them. You might want to do all stuff, kind of stuff. Just be very aware that it's not as clear cut as it might appear at first blush there.
And then I'll just, again, mention this briefly. We decided to put some draft bullets from the Lummis-Gillibrand Responsible Financial Act. There's a lot of other acts that are out there. This is going to look very different by the time something gets passed, but this is interesting to look at, right? Like a lot of the problems we mentioned around crypto lending, what we just said, right? They're going to hopefully extend that. So crypto native companies don't need to worry about triggering taxable events anytime they just want a loan, right? Or the DAOs, right? There's Wyoming and Tennessee that allow it. They would put that on a federal level of recognition, right? Or mining and staking, right? So this is all the clarity, right, that companies are looking for. As Pat mentioned, we do have rules we could look at. There's also existing rules we could analogize against, but having more clear-cut options will just help with increased adoption. So.
We just got a great question, which is Arbitrum good for TGEs? I would say absolutely yes. And I just want to reiterate, thank you so much to the Arbitrum Foundation for sponsoring this. Yes, they absolutely are. It's, it's one of those things like, you want to be able to, especially as we're getting into some of these more complex things, you are going to have more interesting smart contracts that get into it. So any sort of highly programmable chain like Arbitrum that's high speed is great for it. It's a great place to launch your tokens here. If there's any other questions people want to throw out there, we got 1 minute, 1 minute left here. This was really fun. Jack, Rodrigo, thank you guys so much. I learned things. Like I love when I get to do these and I get to learn stuff. Like I didn't know about the 83B stuff for corporations. I didn't know about some of the ECI stuff that's super interesting. It is always worth reaching out to folks like Jack and Rodrigo if you have any questions about either the tax specifics, the liability specifics, or the actual corporate structure specifics here. No more questions. Jack, last words?
No, appreciate everyone joining. Again, happy to help if you have any follow-up questions.
Rodrigo, last comments?
No, yeah, thank you for the opportunity, and strap in, guys. It's going to be an exciting 2025.
Yeah, it's gonna be a wild. It's gonna be a wild year. It's gonna be a wild year. Thank you so much, everybody. Absolutely wonderful time. Thank you for joining. Thank you, Jack. Thank you, Rodrigo. This was great. Have a wonderful day, folks.
Too. Bye-bye.